Hello, this is Diane, DNF Properties. Today is February 7th, and I just wanted to give you a quick market update since the last time we met last week. Buyers are coming back into the market. We are experiencing low inventory, and we are seeing buyers return. Open houses are crowded in many cases. Of course, depends on the price of the property and the location, but we are seeing buyers return. Interest rates have retreated a little bit. Overall, the trend has been lower. So that might be one of the reasons why we're seeing buyers back in the market. Another thing that's going to change here quickly is how much loans cost. But the majority of the loans by Fannie Mae and Freddie Mac that are government backed, they're requiring a change in pricing. All loans have a base price, and then there's overlays or additions that the lenders add on depending on your credit score, how much your loan to value is, your DTI, your debt to income ratio. All those factor into how much of an interest rate you're going to pay. So a baseline rate with 0 points is probably somebody that has a very high credit score, very low LTV, owner occupied. Those people are usually the people that are going to get the best interest rate. Well, starting May 1st, Fannie Mae and Freddie Mac are going to change those pricings that they charge for their loans, which will translate into banks, again, charging this to the consumer. They want to make homeownership available for lower income people. So people with scores under 680 and make less than 120% of the medium income of the area, which is about 90,000 in Santa Clara County, they want to attract those buyers to the market. So they're going to make those loans more attractive by charging less of these overlay or loan, the loan fees that they charge. Someone's going to have to pay for that. And it's going to be the people that pay more, that have the better scores, that have the lower loan to value. So if you're in a really high category, like A paper, A plus everything, you're going to pay more in your interest rate. And that's going to start May 1st, and we're going to start seeing lenders price them in March, April timeframe. So if you're a buyer, you want to get in now before the other buyers get in, number one, because when buyers start, it's a flock. When people start seeing everybody else buying houses, then more people join in. So right now is a good time to buy because the interest rates are still haven't priced in this loan level of price that they're going to place in May. And not all buyers are catching on yet that there's low inventory. So if you're a buyer, I really, really recommend that you start shopping now. Get approved, get your favorite realtor to help you. If you don't have one, I'm here, I'll help you. Just give me a call. But it's really important to get in now because if you wait till April, May, rates will go up a little bit and you are going to be stuck with a lot of competition. Now, of course, if you're in that bucket with the lower, where the rates are going to be decreased a little bit because of the income bucket, the problem with that in the Bay Area is that we really don't have that many loans, houses that qualify for this category. If you're making 90,000 or less, there's not much you can buy in the Bay Area. Maybe you can buy a condominium somewhere, or you may have to travel to the Valley where you probably can afford to buy something there, which I can help you with as well. And the loans will help you there, but Bay Area, it might be difficult. So what are people going to do that are going to have their rates raised because they can afford it? QM loans, those are loans that are not backed by the government. They're not government loans. Those are loans that you could just like jumbo loans that you can get anywhere. Those are going to jump in and they're going to probably offer good rates, maybe on their adjustable rates, etc., for those people who can afford the higher price points. So they're probably going to come in and you're going to see those loans. The only problem with those loans, they have more not restrictions, but they have more, a lot more documentation. They're a little bit stricter on those type of loans, but they're out there and you can get them. So there's other changes that we're going to see where Fannie Mae and Freddie Mac will charge more overlays. If your debt to income ratio is more than 40%, you're going to get hit with an additional fee. If your loan to value is more than 60%, again, you're going to be hit with some more, with those additional overlay fees that they charge. Also, 740 used to be the cutoff for really a good paper, 740 credit score. Now they're looking at 760. So if you're between 740 and 760, you might get hit with another overlay. You might have to go all the way to 780 credit score, which is really high, to not have any of these overlay fees. Also, 2 to 4 units, so income property, second loans, cash outs, going to cost you more. They're going to charge extra overlays for that. They always priced in a little bit more fee on your interest rate for these type of loans, but it's going to be a lot more, not just a little more. Or the fees, the points you pay are going to be a lot more. And another thing that's going to go up, that's inflation, is credit reports. They have gone up quite a bit already. The average credit report for a couple used to be like $70, $50, $60, $70. We're looking at $150 to maybe $400 for credit reports, because sometimes a lender has to pull up more than one, especially if you are trying to fix something and remove something from a credit report, which we help you, lenders help you. I do help you with that as well. After we get all that removed, we got to go get new credit reports. So it could be up to $500 in some cases for credit reports. So all the fees are getting more expensive. And of course, that's inflation. Everything's expensive. So, but I listened to one guy today that talks a lot about loans. He said that he really doesn't think that the translation of that new overlay may not be more than 1/8 of a point, maybe 1/4 of a point. So it's not going to be big, but it'll be there. They're expecting, this fellow that I listen to every day is expecting rates to come down some in the future. So they're expecting things to drop about 1% from where they're at now to 1, maybe a little bit more. So the overlays are going to go up a tiny bit, but the rates in general are going to start going down. The yields on the 10-year note is going to go down. Powell spoke today, and that usually makes the rates erratic. They didn't change too much. They went up only 3 basis points on the yield, 10-year yield, which is not that much. So that's good because they didn't get spooked by Powell. One thing that is happening is all banks around the world are raising their rates, maybe because of what we're doing here in the United States. So that can impact our yields for the short term. But overall, we think they may be coming down in the future. But by the time they come down and inventory goes down, you buyers are going to be priced out of the market. You're not going to be able to get anything. We're going to be back to where we were last year. So I suggest, if you're a buyer, go in now. If you want to look at real estate, give me a call. I'm happy to help you. If you're a seller, it's a good time too, because there's a lot of buyers out there. And I hear some open houses are fetching like 40, 50, 60 people over a weekend. So if you want to buy, if you want to sell, or if you want to get a new loan, I'm here to help you. I'm Diane, DNF Properties, D for Realty and Investments for the loan side. And my number is 408-221-6602. And I'd be more than happy to help you. You have a pleasant day, and talk to you later.